Is this the ninth Sunwest Economic Summit?
Yes.
Ninth. Wow, 9 years. I was just saying to my good friend, he's talking about it was the fastest year that went by in his life, and I'm like, well, look at this last decade. Man, has it flown by. I mean, can you believe it? In just a couple more months, we're going to be in 2019, and then before we know it, in 2020. And we'll be dealing with another set of elections. So, big night last night. Some good, some bad, depending on your perspective. But it's wonderful seeing a lot of regulars here, some new faces, and we welcome you all. Well, we have an interesting program today. We're going to start off with a little snippet on opportunity zones and a wrinkle in our new tax law, because it's very informative and there's a lot of investors out there looking to deploy capital, and there's some real interesting tax elements of these opportunity zones that were wrapped into the tax reform package. Then we'll roll on to a panel talking about the economy, interest rates, where the markets are going, all the rest. So since you're going to hear enough from me, I'll turn it over to the president of Sunwest Bank, Carson Lepetito, who will introduce our first guest, and we'll do the questioning. So carry on, Carson.
So we're going to do a quick 15-20 minute overview of from Square-Milner of the opportunity zones and the tax loophole Eric referenced. And Mike Jakimczak leads the opportunity zone practice for Square-Milner. So he's going to come up and give a quick presentation and educate all of us. Thanks, Mike.
Thank you, Carson, and thank you, everyone, for having us. We're excited to be here today and talk about this opportunity. I know in my career, which is a little over 12 years, this is the most exciting tax legislation I've seen come through, and I think a huge opportunity for any kind of trade or business, but I think particularly real estate investors. We're going to start really quick. I've got 15 minutes or so and want to have a few minutes for Q&A at the end. So with a quick show of hands, how many people here have heard about opportunity zones and have at least a decent understanding of what they are? Okay, great. So I'll go through the basics pretty quickly and get on to what I think is one of the more important components, which is the recently issued regulations and guidance by the IRS that I think closed the loophole on some of our open questions that have been plaguing us all summer. So let's see. So why is this valuable? The Tax Cuts and Jobs Act of 2017 introduced this legislation, and it allows for some really good tax benefits. It allows for a deferral of capital gains and also an exclusion of appreciation on your investments. Deferral is great. I think exclusion is kind of the holy grail of tax, and to get an opportunity to exclude gains like this is a huge tax benefit that can't be ignored. Let's see. So a quick overview. This is related to capital gain reinvestments. So had a lot of questions from people about this. You've got to recognize the capital gain, and you have to reinvest that gain into a qualified opportunity zone fund. There's a time period of 180 days from the recognition event in order to make this investment. There's some guidance I'll talk about shortly that extends out that 180-day window. I think it was very favorable for taxpayers. But overall, the key to understanding is it's got to be capital gain reinvestments. If you put new money in to a fund, then it would bifurcate the partnership interest. You only qualify for the benefits on the capital gain portion that was invested, and it's got to be cash. Let's see. So there are certain neighborhoods, obviously the opportunity zone. There's certain census tracts are designated by the governors of each state. There are some very, I think, favorable census areas here in Southern California. A lot of Santa Ana, parts of Long Beach, a huge chunk of South LA into East LA, parts all over San Diego, and I also work in the San Francisco office, and there are parts of West Oakland and all around the Bay Area that we think are very valuable from that standpoint. Economically distressed, but there are some opportunities to develop, and we think make some money and get some great tax benefits. There's a link here, and we'll send out these slides after the presentation. I've got to go through pretty quickly, so there's a link here. You can see the maps, and you can drill down and see what areas may qualify, and if you've got existing investments. Let's see. So the general on how this works is you recognize the gain on a capital gain transaction, you reinvest into a fund within 180 days. The fund can be any partnership or corporation. And then the fund has to acquire within a certain time period a qualified asset inside this opportunity zone. Now, it can be a real estate development project. It could be a regular trade or business. We see a lot of benefit on the real estate development side because you can manage the asset and control it, staying inside the zone for a period of time, and also the appreciation. The appreciation is key, which we'll get into here shortly. One of the open issues was certification. I think that was preventing a lot of these funds from forming and actually deploying capital up until now, but the IRS guidance, relatively straightforward. You make a self-certification. IRS issued a draft form to do that, and there's ongoing testing requirements. So now that that's been resolved, we've been seeing some funds formed, and I've worked with some attorneys down here in Southern California and also in the Bay Area who have got draft operating agreements and are actually forming these funds and deploying capital. Let's see. So classes of investment that qualify, very flexible. You can acquire any asset. It can be any trade or business. It could be real property, improved or unimproved. It could be an operating trade or business. There are a few requirements with original use of property and substantial improvement. Some of you may have heard about this substantial improvement issue, where if you acquire a real estate property, it has to be substantially improved, which is 1 times essentially the purchase price of the property. There were some favorable regulations that came out a few weeks ago regarding this. It says you can basically allocate your purchase price between land and building, and you only have to spend 1 times the cost basis in the building on the improvements, that was a significant limitation we were coming across with everybody. I think that was very favorable. Prior to that, we were looking at ways to carve out the land and hold it in different entities and things like that to reduce the amount of money that has to be spent, but that was favorable. We can do everything in one fund, and we have to spend less money over the 30-month time period to do that. There is a no-fly zone. Golf courses, country clubs, massage parlors, hot tub facilities, racetrack, gambling. You can see the list up here. This legislation was actually born out of the low-income housing credit legislation. A lot of the same issues apply, and this is one of the limitations for the low-income housing credits. Let's see. So the tax benefits, deferral and exclusion. So you get a deferral on so let's walk through a quick example, and I can kind of go through this really quickly and explain it. Say you've got an investor who on July 1st sells capital assets. Say they sell some stock for $2 million. That's got a $1 million long-term capital gain. Within 180 days, they have to reinvest that $1 million of capital gain into a partnership or corporation. Then that partnership or corporation would then acquire an asset. So there's a deferral component on the 1 million. You can defer it for up to 2026. This is one area when we talk to folks it gets a little confusing. So the deferral is not forever. It's not like a 1031 exchange where you can defer and never have to recognize that gain. There will always be a recognition event, and it's the earlier of the date the investment is sold, or 2026, whichever is sooner. In that case, if you've held the property for up to 7 years, so if you acquire something in 18 or 19, you'll qualify for a 15% reduction in that gain that you have to recognize. And if you've held it for 5 years, you qualify for only a 10% reduction. So to maximize the tax benefits, the key is investing into something very soon. I think you got through 12/31 of 19 to make an investment and qualify for the full tax benefits here. So in our example with $1 million gain, if you hold the asset through 12/31 of 2026, you'll recognize an $850,000 capital gain on that date, which causes some issues. I think you've got to have some cash to pay the taxes. There may be issues. From real estate investment, you could probably do a refinance, do some kind of distribution event or something there to give the investors cash to pay that tax, but that is definitely a limitation to consider when opening up one of these funds. And then, let's see. The giant carrot here is the exclusion. So if you hold the investment for more than 10 years, any appreciation on top of your original investment will never be taxed for federal tax purposes. So in this case, let's say you invest $1 million, you acquire a piece of property, and 11 years down the road, the property is worth $5 million. You would have recognized a portion of that first $1 million in 2026, and then the additional $4 million of gain on top of that will be tax-free. So that's where there's a lot of benefit here. Like I said, we talked a little earlier about the appreciation. Investments that are going to be great investments for this are highly appreciating assets. The deferral is good, but it's only for 7 or 8 years. But this long-term appreciation and the exclusion on this is going to be huge. So let's see. One question that was out there that people had was, Right now, the opportunity zones are only designated for 10 years. So the question out there was if the opportunity zone designation falls after 10 years, can you even hold an investment long enough? And when that designation goes away, will your investment qualify for this exclusion? And the answer in the guidance released a few weeks ago is yes. So it's generally based on when the investment is made and whether the zone qualifies as an investment when the investment is made. So here's a quick timeline. We just kind of walk through it. In the sake of time, I'll skip over this, but we'll send out the slides so you'll be able to kind of poke around these and see what this looks like. Let's see. This is the example we already went through. Spend a little bit of time on the beneficial provisions in the new guidance. We talked about some of them. One that I think is really interesting is this 180-day reinvestment window was pretty tight, and we had capital gain transactions early in 2018. I know I had a lot of clients that were calling and asking, can we make an investment now? And we weren't really ready. No one was really comfortable to make investments depending on the size of them. And so 180-day window starts from the recognition of your capital gain. And if you recognize a capital gain in a partnership or any kind of flow-through entity, you actually get a significantly longer time to make the reinvestment. So if you recognize the gain at a partnership level, the partnership can make the election to reinvest these funds at the partnership level within 180 days of the sale event. But if the partnership does not do so, the individual partners can each elect to reinvest their portion of the gain, and they have 180 days from the partnership's year end to do that. So in this case, it buys us some more time. If you sold something in January of 18 in a partnership or S corporation or trust, you can technically form a fund in June of 2019 and make the investment then. So that bought us a lot of time. I think it was very flexible. And then there's also some interesting guidance from the deployment of capital. You generally have 6 months once you form the fund to then deploy the capital into a qualifying asset. In this case, the IRS allowed us this working capital exclusion, and this applies, I think, particularly to developers where cash in general is a non-qualifying asset in one of these funds. You have to have an asset located in the zone. They excluded the cash from that test, and you're allowed to hold cash in the entity as long as it's pursuant to a written plan or a construction budget or something like that to acquire, construct, or rehabilitate an asset within 31 months. So overall, a lot of flexibility. In theory, you could put cash you could sell an asset in January of 18, put cash in June of 19, and then you could have 30 months to actually deploy that cash into an asset that meets the requirements. So a lot of flexibility with the regulations. I think the Treasury was very favorable with this, and I think there were so many open questions they had to be. Let's see. One interesting thing I found, I haven't heard much about it. When you acquire this, when the fund acquires, they can either acquire an asset directly, or they can acquire a partnership interest or corporation stock in a business that's located in an opportunity zone. Now, it has to be an equity interest. So it has to be an equity interest in a partnership. It has to be either corporation stock and can also be preferred stock as long as it's not convertible and deemed debt for tax purposes. But you can use that interest, either the corporation stock or the partnership interest, as collateral for a loan for any purpose. So this kind of goes against most tax rules. Generally speaking, if you have an installment sale or something like that and you borrow against it, you trigger and recognize tax gain for it. So in this situation, this could be an opportunity to borrow against your partnership interest to pay the taxes in 2026 if there's not a refinance event. But a very interesting opportunity to monetize your transaction early on and not have any negative tax consequences by doing so. Let's see. A couple other issues to consider. Ongoing certification process. There's some limitations right now, the way the rules are written on how large the fund can be. I think if you have a fund, let's say you have a large syndicated fund and you want to acquire multiple properties, there are still some open questions on how you would gain these tax benefits upon an exit. The way everything is written right now, the conservative way to do this is to do one fund per property. In order to recognize those, you sort of have to have a liquidation event or the sale of a partnership interest to recognize these tax benefits. So if you've got multiple properties and you sell one in your fund, the investors may not recognize the tax benefits from the sale of one unless the IRS comes out with additional guidance that allows us to do that. But right now, everything is written as a sale of a partnership interest or your investment in the fund. And then with that, there are some certification issues. When you're drafting partnership agreements and you've got a large syndicated fund, are you going to have an audit requirement? There's testing twice a year to make sure that your assets meet this 90% rule. There may be, if the fund is large enough, the investors may want some sort of assurance every 6 months that the fund in fact meets these tests, and there's no penalties for the partners. And then one other one that's out there is, this is derived off the low-income tax credits. So the question is, can you take advantage of this opportunity as well as the low-income tax credits and other issues there? The answer right now, I think, is yes. There's nothing in the guidance that says you can't. So you could use both on the same property, and a lot of these properties will qualify for both. And let's see. I think that's all I've got to try to keep it quick. Do we have time for some questions, Carson? Yeah. All right. Any questions? Go ahead. Right now, that's the way it reads, because these tax benefits they're treated as step up in basis of the investment in the fund. It's not a step up of the property underneath. So if you've got a fund that holds multiple assets and you sell one of them, you're going to have a gain recognition event at the fund level, which is going to flow through, if it's a flow through entity, to your shareholders or to the partners. And they've got basis in their investment, but they can't use that basis to offset the gain unless there's a liquidation event in a partnership. So that's sort of the way, and unless you sell your partnership interest, which is, I know, more challenging to do than, usually things are asset sales, but you could potentially do an UPREIT transaction or something like that. It depends on the liquidation event of the fund, but we're thinking, at least right now, the easiest way to do it is one fund, one property, and then if you sell the property, you can liquidate the fund and get these tax benefits for the partners. But that may change depending on how guidance falls through. Yes. Yeah. Yeah, they're not listed. I think generally they don't. Depending on the cannabis business, they don't qualify for these tax benefits. But an interesting question. Actually, you're the first person to ask me that, so I don't know the answer to that, but I can take a look at it and see. I would think you've got some issues with taking deductions and other items there. I would think if the business is structured outside of those limitations, it's possible. But the component related directly to those areas of the business that you can't take deductions and have other tax limitations, I would think that those also wouldn't qualify. Yes. Anybody can. That's actually I think this is so flexible because you can do this on a large scale. You can do it at an individual level. All you have to do is take reinvested funds. You can form any partnership or corporation you want. It has to be a live partnership, so it's got to be you and somebody else, or you and one of your related entities, or however you want to structure a live partnership investment. And you can do. We're seeing a lot of smaller scale development projects that are moving forward on this. I've heard of a lot of some larger institutional funds that are forming and raising capital for these investments. They have some limitations, obviously, right now with how to generate and claim the benefits upon exit. But I think you've got some time period, some limited time frame there to do development, the 30-month rule on improvements. I think developments that fall under existing zoning and aren't going to have as much of a political issues may be more beneficial and may fit into this category very well. And those could be our smaller scale developments. I've seen a handful of people set up funds with 4, 5, 6, 7 people in them, purchase a property and move forward. And I think at this point we're very comfortable as far as setting those up and making sure that we qualify for tax benefits for them. Yes. If it issued new stock?
Repeat the question. Yep. Would this work if the existing business was owned by a C corporation, which issued a follow-up stock, and the investor acquired the stock and it was not?
It's an interesting question. It seems like it would. I'll have to get back to you on that one. I think there are some issues. There's an original use issue out there on the trader business side. I think if you acquire the business, it would be original use in your hands. I don't know if I think it qualifies, but it will depend on how much ownership you have versus the old owners, and there are some restrictions there on that issue. I know from their related party rules with this, where if you currently have a property in an opportunity zone, if you sell it to claim these tax benefits, you can only retain a 20% interest in that property going forward. So if you have a property and you want to sell it, you could put money back in or roll into the fund a portion that's 20% or less. So there may be some issues there on the same side, on the trade or business side. But it generally speaking, original issue stock qualifies. If you purchase the business in the zone, it should qualify, but it would depend on some of the other facts and circumstances. Yes?
I think we have time for one more question.
One more? Okay. There's no minimum on the gain. Honestly, I don't know. The only thing we can come up with as far as why it's only capital gains is to limit the cost for the budget when this was instituted. The idea behind the law is to harvest gains that are existing, unrealized gains. If you read the regulations, it talks about harvesting unrealized gains and deploying that capital in these economically distressed areas. That's sort of the spirit behind the law. But at the same time, you could kind of turbocharge this if you allowed new money to come in to these areas as well, but I think it was a budget issue. If you let everybody to come in and form these, it's going to have a significant hit to the budget when trying to pass the legislation. And we have one more, or that was it? Cool. All right, you're welcome. Thanks, everybody.
So obviously this is a relevant topic, and what we're going to do is send all these slides out after this presentation. And we're going to hold an hour to hour and a half extended session over lunch with Michael and some of the other people from their team. So if you're interested, when you get the slides, please respond, and we'll coordinate this meeting in the next month or two. Thank you. So we'll bring the panelists up now, Eric Hovde, Mike Gomez, and Will Smith.
Guys are getting seated. My development company, because outside of Sunwest, I have a real estate development company in Wisconsin. I'll tell you, pull up that map of where these opportunity zones exist. You'll be shocked at some of the places that are designated opportunity zones. We're doing a project that we're doing totally not related to an opportunity zone, and lo and behold, it's in an opportunity zone. And so to be able to defer cap gains, get a reduction in cap gains, and then if you hold the asset long enough to not pay any tax at all is a huge windfall, and that's why I thought it was, Carson and I thought it would be a really good thing for everybody to know about it, because it could have very significant implications.
Okay, so panel is assembled. All of you know Eric Hovde. He's the chairman and CEO of Sunwest. As he mentioned, he's also the CEO of his real estate development company in Madison, Wisconsin, and CEO of Hovde Capital Advisors, which is a long-short hedge fund in the financial services space. Will Smith is the founder and president of Greenlaw Partners. They are a real estate developer, have acquired and disposed of over $2 billion in assets. They operate in multiple states and manage all asset classes. And then Mike Gomez is the head of emerging market portfolio management at PIMCO. And prior to that, he was the head of proprietary trading at Goldman Sachs for the emerging markets. If you guys want to add anything to your bios, feel free. Okay. So we all know the midterm election results came out last night. Hopefully everybody in the room voted. And I thought we'd kick it off by letting Eric give us a bit of a recap on the election results and perhaps your perspective on the impact to the economy with what happened.
Sure. Obviously, we don't know fully how the last two Senate races are going to fall out. One is the race in Montana with Tester, the incumbent Democrat. Right now, he's trailing, but you still have a lot of rural communities coming in with their votes. And then the other race is the Arizona race between McSally and Siena. Right now, McSally is leading, but it's by a very narrow margin. But net-net, how did the night unfold? Not surprising to me, the House went Democratic. If you look at midterm elections, they have always been brutally hard on parties that control the White House. There's only been two midterms in the last 100 years where the party that controls the White House turned out well in the midterms. One was 2002 for George W. Bush, and why did that occur is because we had September 11th, and the country rallied around how President Bush handled that and was supportive. The other was 1998 for Bill Clinton. The economy was booming, and people did not feel that the impeachment process was the right path to be going down at that point in time. But if you go back through history, I mean, both Obama's midterms were absolute disasters for Democrats. Bush W's second midterm was a disaster for Republicans, and you can go right back through history. So the fact that the Republicans lost the House, I'm not surprised. As far as getting anything done, even if the Republicans would have controlled it, they would have only kept it by a few seats. Nothing would have gotten done because they wouldn't have been able to obtain the votes to really push any meaningful legislation through. The fact that the Senate stayed in Republican hands is a very big thing if you are a Republican, because it will allow President Bush or President Trump to continue to move his judicial nominees through the process like they did with the last two Supreme Court nominees. So I think we're going to pretty much be starting the 2020 election tomorrow. Everybody will be, you know, either if you're the loser crying or celebrating if you're the winner, but we're off to the 2020 election. In some strange ways, even though, you know, the White House will be inundated by subpoenas by the Democrats that control the various committees, in some ways it may be a blessing for President Trump in his re-election chances, because now he has somebody to run against, and in this case it's Nancy Pelosi, the least favorable politician of any party. So in a lot of ways, it may be the very best thing that happened to President Trump is to lose the House. So I think it's kind of net a wash. The equity markets are up today because the Republicans kept the Senate. You know, I think we'll have gridlocked government, and that tends to happen in the second 2 years of a presidency. And as I said, the 2020 election, every candidate will be running around, starting in Iowa, I can tell you within a few months. So,
thank you. Now to the economy. I'm going to come right back to Eric with the first question. Last year, your prediction was that the U.S. economy was going to do well, but there was going to be more volatility in the equity markets. What was your concern that caused that? And do you think the recent equity market sell-off is what you were talking about, or is there more to come?
Well, let me first explain why I had those concerns. Principally, the equity markets and the economy, while most people think they're directly interlinked and they will move together, that is not always the case, and quite often they can diverge. Because of the deregulation, the tax reform package that got done, and a variety of other things, you could see pretty well that the underlying U.S. economy was going to be pretty strong coming through this year. It's been the best economic year that we've had since back in 2006, and this year it's better on more healthy underlying dynamics. However, why did I have concerns about the equity market? For two principal reasons. We had been in a zero interest rate, 0 to 25 basis points interest rate environment for a long period of time. After the Fed cratered rates back in 07, 08, 09, I mean, we're sitting at a 0 to 25 basis point interest rate environment for a long period of time. And then all of a sudden, post the 2016 presidential election, the Fed has started to move. So we now have short rates at 2 to 225. And looking like they're going to move in December and May. You know, the question is how much do they continue to raise in 19? But the other big reason why I was concerned is one of the things that the Federal Reserve did during the big collapse from 07 through 09 is they massively expanded their balance sheet. The Federal Reserve's balance sheet was always around $700 billion. The Fed came in and expanded their balance sheet by almost $4 trillion. So they pushed their balance sheet up to about $4.6 trillion. How did they do that? What they did is they went into the private markets, bought treasuries out of banks, out of insurance companies, out of private investors, as well as mortgage-backed securities, and put it on their balance sheet. When they're buying that, they're sending back cash. So everybody that held those securities was all of a sudden getting this wave of money in their hands. Well, what were they going to do with that? They're going to invest it. So a lot of that money went into the equity markets, it went into the real estate markets, it went everywhere. As a result of that, you saw, even though the economy was struggling terribly at the end of 09, 010, 011, you saw the equity market start to lift because this wave of money was pushed in and started chasing returns and higher risk assets because the Fed took out all the lowest risk assets out of the system. The Fed last year, in October of last year, started the unwind of their balance sheet. Very small at first, only 5 to 10 billion at the beginning. Just now, they're now to where they're fully deleveraging and shrinking their balance sheet. Every single month, they're shrinking their balance sheet by 50 billion. Now, 50 billion is a huge number, but in any given 1 month with the size of the total economy, not that much. But 50 billion every single month, and you go 6 months out, a year out, that has significant impact. So that is what the equity markets and a whole host of other markets are dealing with, is the Federal Reserve shrinking their balance sheet, taking money back out of the system, and as a result, I think asset values, principally the equity markets, are going to have trouble. And I think they will continue to have a lot more volatility. Not to say they can't go up, because they can. It's just you're going to see a lot more volatility, and I think you're probably going to see more pronounced sell-offs than we certainly have been used to.
Thank you. So taking this over to the emerging markets, Mike, in '98, there was a very large equity market sell-off because of, in the emerging markets, Asia and Russia particularly, long-term capital management. And it was caused by rising interest rates and a strengthening dollar. Do you see a similar risk today?
Yeah, thanks for that. I think that the dynamics in emerging markets today are very, very different than we saw, call it 20 years ago with LTCM, 1998, and Russia. Of course, 1998 followed 1997, which, if you remember, was the start of the Asian crisis. And the characteristic of that time in emerging markets was about 90% of emerging market economies at that time had either fixed or pegged exchange rates of the dollar or very heavily managed exchange rates against the dollar. So any time that we had a stressful period in global financial markets, a great deal of stress would come into emerging markets, and they were unable to allow their currencies to act as a shock absorber. Okay, so just think about what we do in the developed world. If we have a situation where the US or Europe happens to be growing in a desynchronized fashion, oftentimes that's represented in a change in our exchange rate against another country. So going back 20 years, emerging markets didn't have this capacity to allow their exchange rates to fluctuate. The situation in 2018 is quite different. That statistic has been flipped on its head. About 90% of emerging market countries today have fully floating exchange rates against the developed world. So this allows them to navigate shocks that emanate either internally or externally upon them in a much more effective fashion. So if you think about 2008 and 2009, the global financial crisis, made 1998, 1997 look like kindergarten. Okay, and emerging markets, for the most part, came through that very, very well, in part because of this ability to have the exchange rate do some of the shock absorbing for their economies. So I don't look for that sort of domino impact that we saw in 1997 with Asia and then into 1998 to be sort of the primary cause of any crisis. What we certainly have to keep an eye on is the interplay between U.S. policy, particularly on the trade side, and what's happening in the Chinese economy. So when we look for causes of global slowdown, as Eric talked about, and we look for areas that may cause more stress, the Chinese economy, the interplay with the U.S. as it relates to trade, I think is something to keep a close eye on. If I can very quickly, just back to Eric's point on the election, just one thing I would add on that. a lot of people we talk to at PIMCO about the dynamics in the House. There are sort of two competing interests that come up. The first is that actually, and President Trump, perhaps a little bit tongue-in-cheek, endorsed Pelosi today as next Speaker of the House. Why would that be? A reason for that, we think, is that whatever you think of Nancy Pelosi, she may be the person who is sort of most level-headed about not sending House Democrats on a chase towards impeachment ahead of 2020. Okay, perhaps somewhat ironically, she may be the person that sort of keeps more of the sort of radical left side of the House in line as we head towards 2020 elections. And then I think, while I would tend to agree with Eric, I think the big delta in terms of governability for the next, call it 18 months, is whether or not anything happens on an infrastructure bill, the infrastructure side. And a lot of the Democrats that we talk to, profess that what they would like to achieve into 2020 is show, hey, we can govern too. Hey, we can be effective as well. And so, they swear that they want to work with this White House and work with the president. Whether or not it actually happens or not, we have some significant doubts. But I would say that that's a little bit of the delta to the outlook, because without that, I think, as Eric mentioned, you start to get some of the impulse that's come from fiscal policy in the first half of this administration starting to roll off in 19 and 20, and that's part of the reason why people are thinking about doing an infrastructure bill into the election, into the presidential election season.
Great. Well, let's take this over to real estate now. We've talked about the underlying economy doing well, but rates are rising. What do you see as the your outlook for the commercial property markets, and particularly multifamily, because obviously that's a hot button right now?
Sure. We've been buying multifamily and selling multifamily, and I think the rising rates certainly affect stabilized assets where buyers are going to place loans. The core funds buying stuff without debt, their yield expectations have continued to shrink, and deals are getting tighter and tighter. You're seeing the same in industrial as well. So if you have a real value-add deal with good basis and you got a chance to move rents because the old owner just hadn't done it, there's still opportunity out there. But at the same time, the large institutional deals are getting tighter and tighter, and equity's getting cautious. And I think you're starting to see more and more discipline. And in markets where a lot of product's being built and concessions are starting to be given a little bit, those areas are going to be a little bit more challenged and a little bit more dicey.
Will, have you seen, sorry, just to interject, what's been kind of surprising to me is that cap rates haven't moved up as rates have moved up, because typically real estate values, a line my father always used to say, real estate values float on a sea of finance. It's the cost and availability of that finance that will ultimately determine values. And it's just been interesting as we've seen, the Fed has increased rates by 200 basis points, and the 10-year has moved now, like 320 this morning, that cap rates haven't seemed to move correspondingly.
Yeah, the feedback I get on that, because from a volume standpoint, not necessarily deal size, a good component of our business is high net worth joint ventures, and the other part is institutional joint ventures. And the institutional equity view industrial and multifamily as a safer asset class, and they're continuing to put money into that, with discipline, but the yields are coming down. Just they feel it's a little safer place to park money. And even from a land standpoint, I thought there'd be some impact, but we have a lot of entitled sites, especially in Orange County, and we're selling, and I haven't seen the price per door on paper lots come back yet. In fact, they still get pushed a little bit, which is a good thing if you're a seller. But yield requirements have come back. Folks are buying stuff, spending more money with less of a return, and they're taking more risk. That's the hard part.
Wow.
Okay, let's pivot over to growth. We'll go back to Eric. What do you see for U.S. growth in 2019, and how long do you believe we'll be able to continue this growth rate in the 3 to 4% range, and the tight employment market that we have now?
Well, I think 2019 is going to continue to be a relative, I'm not going to use the term relative. I think it's still going to be a good, strong economic year. I'm not going to say every quarter we're going to clip along at 3.5 or 4% growth rate. In fact, I wouldn't be surprised if we had a two-handle in there for some quarter this coming year. But overall, I would probably forecast we're somewhere in the low threes for overall growth rate, which sure feels good versus the 1.5 and 2% growth rate kind of average we had for a long stretch of time. You will start to lose a little impact on certain interest rate sensitive markets, housing being a prime example of that. If you look at, California is a prime example of it. You're already seeing housing values pull back a little bit and volume really decline. Why is that? Well, we had this big run back up in housing values that was largely supported by very low interest rates and, as a friend of mine said, dual incomes. You pushed them to a point where young people could no longer afford buying a home. And now all of a sudden you've taken interest rates up and the 10 years at 3.20, the 30 years at, call it 3.35, and that has a big impact. And then just the cost of building housing. So we're not getting the supply put forth. So as a result, I'm not by any means alluding to the fact that we're going to have some housing collapse, because actually I think housing will fare largely better in the next downturn than most asset classes, because what I've learned by history, whatever asset class did worst in the last cycle does best in the next, and whatever did best in the last cycle does worst in the next, which is what has me concerned about multifamily, because everybody's just been overbuilding. But back to your point on growth rates, I do think the higher interest rates are going to start taking more of an effect on the consumer, which is, for a long time was about 70% of GDP consumer spend, a little bit less now. But it will have an impact on consumer spend. The one good thing is we've had some wage inflation. Finally, the American worker has been benefiting from the overall economy, and that is starting to kick in, so that will help. But I think all in all, 2019 will be a pretty good year. I do worry about a black swan event coming out of China, and so I'd be interested in what Mike's views on that if you ask him about China or anything of that nature.
Well, let's go there because, in contrast to the U.S., obviously global growth's been slower, and you're seeing a decline in China, and Europe continues to muddle through. So, if you don't mind, give us your outlook on global growth and break it up by geography.
Yeah, so we're pretty much calling for a slowdown across the board in 2019. So global growth for the year ahead, we have coming in at about 3% versus about call it 3.25% to 3.5% for 2018. The point estimate's about 3.3%. And if you look at it, we actually have the U.S. while leading the pack also slowing. So in a range of about 2.5% for 2019. Again, in part because you have an expansion which is very long in the tooth. That expansion received a boost from some of the fiscal stimulus programs we've had recently. We do have interest rate policy which has gone up significantly, as Eric mentioned, 200 basis points. And our forecast is probably we're going to get 25 in December 2018 and likely another 50 basis points cumulatively in 2019. So the cumulative impact of all that likely means that that growth in the U.S. in our mind will moderate. 2.25%, 2.5% is still in real terms, is still a pretty decent growth rate for the U.S. economy this deep in the cycle. Unfortunately, I think as Carson mentioned, when we look around the globe, we've also marked down our growth forecast for Europe to about inside of 2%. So call it 1.75% to 2% for Eurozone for 2019. In part, I think that reflects some of the political fissures that you're seeing now in Europe, and principally what's happening in Italy as it relates to their budget negotiations. and their growth rates really seem to be turning back down. So the risk there is you start to get a recession in a place like Italy, which is a structurally significant, important market for the global economy. And then when you turn to China, we also think that that the headwinds are going to persist in China for 2019, and there the real growth rate we have penciled in somewhere between, call it 5.75% and 6%, and that is relative to, let's say, an overall market consensus of about 6.25%. And there, I think, what we've been seeing in China is that the leadership there has been trying to slow the economy, I think, in a sensible fashion. The issue is, for them, how do you maintain relatively high growth rates, but more long-term durable and robust growth rates? How do you have your economic model to be rebalanced such that you are not subject to booms and busts? The difficulty that China is facing right now is that as they are trying to slow their economy, they are receiving a little bit of a push in the back from U.S. trade policy. And so the Chinese sort of are facing two uncomfortable choices, as they decelerate. Either they don't take action to try to sort of parry off the headwinds that are coming from trade, and they risk having their growth trajectory sort of turn down more steeply, right? So that's one side of it. The other side of it, which is also unappetizing, is that they unleash a set of short-term stimulus measures to try to sort of goose their economy in the short term. You turn it back up cyclically, but then that leads to a longer and more durable downturn in the future. So the Chinese right now, I think, have a delicate balancing act to try to undertake, and that's part of the reason why we think growth outlook for 2019 is going to be marked down versus 2018.
Thank you. So let's now pivot to interest rates. Let's go across the panel and have a discussion about your outlook for interest rates and inflation, starting with Eric, and then work it across.
I think the Fed moves in December. I think you get one other move in beginning of 19, and then I think they're going to take a pause and just watch for data. My guess is, at best, you get two moves in 19, because I do think the end of the year is when things will start getting slower and a little bit more dicey, and I am concerned about 2020. The big issue underlying driving that is, what is the inflation data? We've had a U.S. dollar that's rallied very strong, which helps mitigate inflationary pressures in our country. However, we have a labor market that is unbelievably tight. I mean, 3.7% unemployment rate with the real unemployment rate at 7.4. That's called the U6. That factors in disgruntled workers, people kind of sitting on the sideline. And even those people have been coming back in. The participation rate is finally starting to move back up in small increments. So if you get more wage inflation that then spills over a bit, then I would say, hey, throw away my interest rate forecast that you may get more rate increases. But right now, my best guess is you get two more definitively, maybe a third. The economy starts to weaken, employment starts to moderate, some of the tightness there. You still may have a bit of wage inflation. And by the way, folks, the wage inflation numbers are much higher than what they say. You got to understand, all government data has flaws because it doesn't factor in a whole host of other things on how you can benefit employees. Like at Sunwest, after the Tax Reform Act, we increased 401k matches, co-payments on insurance, just a whole host of things that don't flow into how they measure inflation. And even bonuses take a whole year before they get kicked in. So I think wage inflation is running a bit higher than what the government numbers basically say. But again, employment is one of those lagging indicators of economic data. You have forward-leading indicators, and employment tends to be a lagging indicator. So I think that will probably moderate at some point in time.
How about you, Will?
I agree. I don't think the markets could handle 100 basis points move over the next 12 months. It would just be a lot. You're not seeing the rent growth in all product types in all areas that can support that. Certainly there's some micro markets that are still strong, but you know, we're seeing some flattening in certain product types rent-wise. Heck, Office Irvine's company's giving concessions, and they're doing 275 full-service deals on Von Carmen. I mean, that was 2014 rents. So I think, you know, probably 50 basis points, maybe 75. If it moved 100 basis points, boy, that'd be pretty strong.
Well, from a 10-year perspective, because as a real estate developer, that's what you largely finance off of, kind of a
You underwrite to a 10-year stabilized return.
Yeah. So where is that point for you as a developer where you say, if the 10-year yield moved to X, that you'd say, it's just none of our projects are going to pencil? Is that 350?
Well,
Is it
you look.
375?
Well, the way we look at it is, if you do a 10-year, anything under a unlevered 7.5, starting to get super thin, at least for our model and how it all works. There are plenty of groups doing them in the 6s, especially in industrial and multifamily. But those are core funds, not using debt, and they're putting it on balance sheet and holding it a long time. So it's tough to compete or consider that competition, at least in most of the model and space that I compete in.
So another 50 basis points.
It's a lot. It's a lot, because what it affects is the cap rate. And then the question is, how are you going to look at it? If you're going into one of these your self-directed opportunity fund, then into a zone, as the speaker said earlier, and you have a 10-year mindset because you want to get a complete tax pass, besides the initial gain you got to pay in 2026, it's a bit of a different mindset. And in fact, there's going to be a lot of opportunity there. There's also going to be people screw that up. There's going to be some disaster there, because there are going to be syndicators that are doing it for fees that don't trade on their own dollar, and they're going to sucker some folks in, and there's going to be problems. And in the next cycle up, there'll be some opportunistic buys there, because that will get messed up. But then there's going to be a lot of people that know what they're doing and do it right. And besides home ownership, where a single individual gets $250, a married couple gets $500. I mean, that's the only other real tax-free thing that I know, and it didn't have a cap. Where homeownership has a cap on gain. So it's a significant opportunity. And I think those will underwrite different, because those buyers, the good ones, are trading on their own account and looking at whole dollar over a period of time, an equity multiple, not a defined IRR. They're probably not chasing a hurdle or something like that. So if you want to get in and out, and you think rates are going to move 50 to 75 basis points, how honest are you going to be on your exit cap? So that the underwriting gets changed a ton. If you look at your own deals and you move your exit cap 25 or 50 basis points, 24 or 36 months out, that sensitivity is huge in a lot of these deals, especially when you're using leverage to get there.
Thank you, Will.
Before we move on to Mike on interest rates, Will, you mentioned weakness in the office market. Are there other asset classes that you're seeing weakness develop?
Well, I mean, I wouldn't say flat out weakness, because there is an area that there is weakness, and I'll share, at least I've seen, and folks in office be interesting to see what you've seen as well. Because over the summer, in Orange County, average tenant's about 5,000 feet, right? We're still a small tenant market, but what I've found over the last 6 months, most of the deals that we've been doing are huge, a lot larger deals. And I went through it in our portfolio. I think we've done 5 or 6 deals north of 75,000 feet. I mean, those are decent-sized leases that aren't always the norm around here. And the smaller tenants that a lot of the multi-buildings, or if you got a larger building and the last 15% of your rent roll are 2s, 3s, 4s, 5s, and 6s, they were dead. That market was dead this summer. And I haven't seen it dead like that. I mean, I've been in this business here since '03, and I haven't seen it dead like that. And so I started polling and trying to figure it out. I did a poll even in the CB office with all our tenant reps, because everybody's repped now. Retail's repped, industrial's repped, office is repped, everybody's got a rep. Well, WeWork's, I think, stealing all those little tenants. They're paying 20% commissions to these guys just to drop the guy off the door. So as a landlord, you're taking them in, right? They sign 55 or 60 at Boardwalk. It sounds like they're going to try to do another 60 at Kilroy to backfill Pathway. So landlords take them to fill their gap, but then all of a sudden they turn right back around and compete with you in all your small space, and they're paying your tenant rep up a 20% commission. You know, I'm not doing that. So they now all of a sudden get into the landlord business, and they're they are the largest occupier of space in New York. I know CB's doing some things to try to figure out how to play off of that. That dynamic is interesting, especially in the small space. And the hard part for us is when you pay huge fees and the brokers don't have to do anything, you sign them up, right? That's an easy one. And then they don't sign leases. It's a license agreement. So it'd be good to get the Squire guys back up here, but everybody else that signs a lease, the way that gets put on your balance sheet and amortized out, over the term of the lease and how you have to hold it, a license agreement, you don't. So there's got to be some lobby or cleanup on that, because corporations that are signing these flex overflow spaces, they don't have to pay for furniture, and they're paying huge rents, but they're not putting it on their balance sheet the same way as if they signed a lease with myself in Irvine or Eric in Wisconsin. It's just different. Not necessarily fair, but it's different. So that's changed up a lot. And so I think that area is tight, but the big space, we're getting really strong rents on big deals, and we're getting good credit. There are a bunch of large deals going down around here. So it's changed up a little different, and there's certain areas that are soft, but certain areas that are really strong. And with these big leases that we sign, we're going to have a bunch of product we're selling in 19. It'd be interesting to see where it trades with buyers. Sign on one deal, it's a 13-year lease with a public company. And when that trades, what buyers look at that on a 13-year lease and how they view their acquisition cap, knowing that rates are moving probably in the next 4 or 5 months. It'll be interesting to see how that goes.
Well, thanks, Will. That was very enlightening. Okay, Mike, why don't we go to you on interest rate outlook?
Yeah. I would say not materially different than what we heard from Eric and Will. I think the one thing that we try to keep in mind is that, so this is a Fed that right now has been raising rates essentially every quarter. Okay, so the model with the Federal Reserve in the past was whenever they started a hiking cycle, essentially they would go every single meeting, and they would keep going until they unfortunately break something. In part because of what we talked about, the global financial crisis, and the need to be more diligent in terms of accommodation. When the Fed started raising rates in this cycle, they really went to more of a quarterly model. Okay, so next meeting comes up in December. They raise rates in September. Next meeting we think we'll raise rates will be in December. Okay, so if you follow that, then of course we head into March, which is where we anticipate another 25 basis points. And then the question from there is, what do they do at that point? The other thing that the Fed has done, that this Fed has done, is they have changed the way they communicate with the market. Okay, so now they will hold a press conference after every FOMC decision. Okay, so it is, if they make a change, now they have to explain it. And that is a little bit harder to do because you get instant feedback from financial markets. So we think that the Fed wants to pause. Okay, so similar to what Eric said, we think that they want to get to March and that they want to pause. The issue is that this Fed is significantly less rules-based or driven by theoretical constructs. It is much more driven, I think probably appropriately so at this point in the cycle, by the data-driven impulses they're seeing at each meeting. Okay, so if the economy keeps on humming along at a relatively reasonable pace, if the monthly employment numbers continue to print somewhere between, you call it 175 and 225 in terms of employment creation, they're going to have a very hard time pausing. Okay, and so a consultant we have at PIMCO is fortunate enough, Ben Bernanke. And even Ben Bernanke is, like all of us, he can be pro-cyclical. And so, when the economy looks like it's slowing and the markets are wobbly, he may say, okay, well, look, they're going to do, only 2 more and then stop. And then when the markets turn back up, he says, well, I think maybe they'll do 3 or 4 more and then stop. And so I think the risk with this Fed is that because they are not model-driven or theoretical-driven, they are less thinking about, concepts like real neutral rates of interest or R-star, and or like what levels of NAIRU might be, that they will be focusing on, is the economy running hot? If the economy is running hot, then we'll continue to raise interest rates. And so the risk is that they keep going until they look in the rearview mirror and they say, whoop, we've broken something. So, our baseline forecast is that go 25 in December, They go 25 in September. They look to pause. They probably go once more again in March, and then beyond that, significantly harder to see.
Hey, Mike, real quick
Yeah.
question, because again, like I talked to Will, most of our borrowers are looking at 5-year and 10-year yields.
Yeah.
And obviously, we have really flattened the yield curve. I
Yeah.
mean, if you look at where the 5 and the 10 and the 30-year yields are, I mean, they're just all crunched down. What do you see for those 5 and 10 and 30-year yields in your guys' forecast?
Yeah, I mean, as you mentioned, the curve has flattened dramatically, and many people ask the question or speculate, is that signaling a recession down the road? Historically, when interest rate curves have inverted, that recessions have followed. I guess because we don't see a recession on the horizon for 2019, we're a little bit more concerned about 2020, and we do think that the economy continues to deliver decent job growth. I think we see the yield curve starting to re-steepen. Not violently, but we see 10-year rates moving up towards probably 3.5%. But at that type of level, we have a hard time. I think, similar to what Will was saying, we have a hard time seeing rates go materially higher than that, simply because we still generally have a finance-based economy, and at some point, those higher rates start to bite and start to be a drag and are self-reinforcing for the growth rate to come back down.
Thank you.
Let's take a little deeper dive into China now. You mentioned the slowdown,
Yep.
and if you can add some more color around it, is it based on the tariffs, the high levels of debt they have, just aggregate policy changes?
Yeah.
Why don't you provide some color there?
Sure. I think, so as I mentioned, I think the Chinese were sort of very well-intentioned in trying to engineer this slowdown. And just to put some context on it, if you went back 10 years ago, we were talking about, real growth rates in China of roughly 9%, with inflation levels of roughly, call it 6 to 7%. So you were talking about an economy that was growing at 15% nominal. Okay. Today you're talking about, more like nominal growth rates that are, closer to 9%. Okay. And so I think what the Chinese have tried to do is move away from a growth model that was very investment-oriented and very export-led oriented, and one that is a little bit more durably, domestically demand-oriented or service-oriented. Okay, and so the idea is basically that if you move to a more of a service orientation for every point of GDP growth, it is much more labor, job-intensive model and a more sustainable model in the long run. So the Chinese have been trying to pull off this change in balance in the structure of their economy. Part of what they've been trying to do is to de-lever their economy. Certainly they've had a very large impulse coming from the real estate sector. There's been a great deal of debt that's been built up in that sector, and so the Chinese have been wary about sort of a little bit of a risk of a debt deflationary bust. As I mentioned, the risk that they have is that when you have an economy that's slowing and you have debt that's built up, if you don't manage it carefully, you can slip into a dynamic which is much more onerous, more like similar to I would call it a debt deflationary bust that we had in the U.S. in 2008 and 2009. So this is what they're trying to manage. I would say, for better or worse, in a command economy, you have the ability to sort of make decisions and move things around with a little bit more blunt force than you might have in let's say, a Western run economy or democracy like the United States. So there are things they can do to try to change the dial. They can change some of the tax regimes that they have in real estate. They can alter things like the amount that must go down for second properties in order to incent growth and incent production. But again, I think the risk is that if you have a confidence shock in China, that you can start to get a little bit of a move towards capital fleeing out of the country, like we saw in 2015, and you can start to get a little bit of an unwind of the story. That is not our base case. That's something that we have been mindful of and watching for quite some time. So for now, we think 5.75% to 6% is a decent number. But we should keep in mind that 5 years ago, 6 years ago, we were talking about 8% real growth rates in China. 5 years before that, we were talking about 9 to 10%. So this is an economy that's slowing. It's going to continue to slow. It has to. And we don't mind seeing 5.5 or 6% real growth rates in China as long as the model is one that is more durable and more robust.
How are they going to manage through the significant debt levels, specifically at the provincial level?
Yeah.
When you talk about that level of growth.
So, a couple things. In this cycle, which is a little bit different than we saw a decade ago, you actually are seeing some entities fail in China. You are seeing some debt write-downs and some workouts happening. So, I think what they have tried to do, with this growth in local debt is, to recognize where there are some unsustainable structures, but not try to signal too violently to people that their capital is at risk, right? Because that balance between saying, look, if something's unsustainable, we don't want to prop up sort of zombie structures versus like, where's the next shoe going to drop, which can lead to a panic or run on the system, is a balance that they're trying to get right in the first case. The second case is, for the most part, the vast majority of the debts in China are locally denominated, so CNY denominated, and we think that they can be, the vast majority of them can be absorbed by the state over time. So what you really want to do if you have a debt problem, you have a fixed stream of payments that you owe, generating some inflation is a good way to sort of cure that the value or the stock of that debt. So, changing some of the local investment rules, absorbing some of that debt on the balance sheet, trying to perhaps inflate away some of that debt are three ways that they can deal with it. For the most part, we think it's manageable, but it's certainly something worth monitoring. I think just a case in point, if you went back and looked at China, again, 8, 9, 10, 12 years ago, we heard a lot about sort of these ghost cities, right? Like 60 Minutes at a special one. For the most part, those ghost cities have been filled in at this point. The issue is, how much have the property companies already borrowed in order to build the next set of ghost cities that they're hoping they'll just fill in again. And that's kind of where we are in the cycle, where the money's been borrowed, and now we have to figure out whether or not that revenue stream actually comes.
So staying with China, over the last few years, there's been a lot of fund flows into the U.S. Coming through the EB-5 program and direct investment, and California's been a huge center of it. Have you seen these flows slowing with what's going on in China?
So that area is a little bit outside of directly what I do. I think Will may have seen more of that in terms of his market.
Yes.
I was going to him next, so why don't we can do
We've
it.
seen it at Sunwest too. So,
But yes.
yes, and it's slowing.
The only thing I would say about that is, in 2015 and 2016, when it was the last time you started to see Chinese currency depreciate, at that time that the Chinese were super interventionists in their own equity market. And there was an undermining of confidence in the local economy and in the currency. And at that point, there was very, very large capital flight coming from China, and in part, I think, the U.S. and other, Western-type markets were great beneficiaries of that. Part of what the Chinese did is, in order to try to sort of contain this pressure, they clamped down very heavily on the capital account and letting capital come out of the economy. So, and then subsequently in 2017 and beginning of 2018, when the markets calmed down, they started to loosen some of those controls. So we haven't seen it in as much of a draconian fashion as we saw, let's say, in 2015 and 2016. But again, it wouldn't surprise me, to hear from these guys that, that pace has been more tepid.
You take it first,
Yeah,
Will.
Will.
Sure. So yes, a lot of EB-5 deals were put together. There's already some lawsuits going on in that space. Several of those deals, I think, are going to be a mess. Some are going to work out, but some are going to be a mess. And I think there'll be some opportunity when the cycle does come to take advantage of great basis in some of those, if you want to touch them. Some of the ones that are pretty heavy urban retail that aren't in urban locations, I don't know what you do with those. So it's going to get interesting in that space. I know of a couple of EB5 sites where they actually own the land. They had a big plan, and they realized that the plan is completely out to lunch, and I don't know what they're going to do. I think that space is super dicey, and there's problems there.
Yeah,
And it has slowed, and not just the EB5 investor, but I think of a lot of the assets I've sold. Go through the list that we used to get quite a few high net worth private bidders, and we sold a couple, but the strike, even when there was a lot of money, the actual ones that executed, the percentage wasn't always that high. You know, they'd be a high number, you take a chance on them, some of them would hit, a lot of them would flop. Sometimes having a hard time getting money out of the country a few years ago, and I think that was pretty common for a lot of folks. And the ones that are buying, I think, are either families or people that somebody lives here in the community, money's already here, and even though from a profile standpoint they might fit the Chinese investor, but man, these folks are here. They really are here, and I consider that person a local investor at this point because they live here, money's here, they're invested in the community. But brokers will tell you, oh, it's a Chinese guy or something, but it's not the case.
Eric, do you want to add anything?
Yeah, you know, we were talking about the housing market with our credit team, and my chief credit officer was talking about the Arcadia market, West Covina market, and all the rest, where just a year ago, homes that were put on the market, a Chinese buyer would walk in, offer 10 or 20% over the ask price, and pay all cash and close within a week. It was people trying to get their money out of China. It's over. I mean, projects are sitting there, and the Chinese buyers not showing up. A large part of it, and which is the big underlying concern, and one of the reasons we're spending a lot of time talking about China, is not just because of its fund flows into this country, but its impact on the whole global economy now, given its size. I mean, when you talk about, you know, which country absorbs the most commodities, it's China. So when you think about building and all that goes into building a building, all those commodities are very influenced by China and its purchasing power. And there are really underlying concerns because in this command economy, they tell you what their growth rates are. It's probably not that. I mean, if you've ever been in China, you pick up a paper, it's the opposite of our papers where everything here is gloom and doom, and there, no matter how bad things are, everything's sunny and wonderful, you know? So they'll put as good a painting over bad economic numbers and try to make things look a lot better than they are. But it's very clear that with President Xi, who's shutting down a lot of the corruption and trying to stop the flow of money out of China, it is starting to have its impact without question of what we're seeing into these U.S. markets.
And they were the anomaly buyer, though. So all that's done is taken that anomaly buyer off the table. To quote a pretty prominent brokerage team here, they'd say, if you get that anomaly guy, you get your deal to Happy Land. And every once in a while, you'd get to Happy Land on a sale. But now, it's, you know, you're just kind of in a normal market pace of stuff.
I would agree with that on commercial, but not necessarily
not
on housing.
Yes, that's
on
right.
single-family housing, there were pockets even here in Irvine,
Cash and fast,
but certainly up in pockets of LA where they were absolutely driving the market.
Yeah, that's true. But just back to cycle-wise, the other thing to be mindful of is watch the flow of capital. All this stuff in real estate, I believe, all goes off the flow of capital. And there's a bit of a lag in commercial because when you look at the allocations, global funds, one of our global fund partners is putting half their money in overseas in Europe because they feel there are better opportunities there. But the domestic ones that can't, when they get their allocations, they're not giving it back. So you really got to watch and be mindful of allocations, when allocations are given, who gets it, and then how they spend it. Then at some point, if you remember, when it all fell apart, that stuff just shut off and folks didn't get allocations. But when they have it and they have periods of time to invest, I mean, that money's going to get invested. So just be mindful and watch the flow of capital to give you a little bit of a lead in how things change up, because that really is a major driving part of it all.
I'm going to risk muddying this tremendously, but you know, the sort of the one part of the shift that we've seen over the last, you know, call it, you know, 3 years in global capital markets is that, you know, as China's aggregate sort of trade surplus numbers still very large trade surplus with the U.S., but in aggregate now, China runs a much more balanced set of trade numbers against the globe. What we've seen is that a lot of that trade surplus globally has now gone to the Middle East, as well as gone from 25 again back to the high 70s. So I'm just wondering, whether or not you guys have seen sort of that pocket of money come in. And then the other thing I would mention is, as we talk about commodities, sort of the one commodity that we think is really just being driven off of those Middle East dynamics is oil, because almost every policy initiative you hear from the Trump administration now, in one form or another, circles back to Iran and to sanctions, and so that really has put a very nice floor under oil markets, at least for now. So I don't know if you guys are seeing like sort of those petro flows come into real estate or not.
I haven't seen it here in California. I have a friend who's a big developer in Florida, and there's no question they're starting to see some of that in Florida, but I haven't seen it showing up in the California market.
I get one institutional partner. Most of the money that went into their fund was domestic, and now I think, at least what they told me, we just went to their annual Global Partners meeting, and most of the money coming in is Middle Eastern overseas, and they're spending a lot of time over there raising it.
All right, we'll move this back a little more domestically. Eric, why don't you give us your outlook on tax reform and the impact on the U.S. economy, and then California as well, given some of the SALT issues?
Sure. Let me make a statement so everybody fully understands the Tax Reform Act that President Trump and the Republicans passed. It was very little about personal taxes. It was everything about corporate taxes. Why? America ended up having the highest corporate tax rate in the world. As a result, capital is not stupid. People that control capital, like all of you, if you're sitting there looking at building a plant to make, call it pipes, for the shale or the fracking industry, the oil industry here in the U.S., would you have built that plant here in the United States, or would you have put that plant in Mexico or in Canada, where your corporate tax rate was materially lower? I think Canada's is 20%. We were at, 35 or 36% corporate tax rate. It was driving business investment out of this country and had been for well over a decade. And that was one of the big things that hollowed out, the Rust Belt in places like Wisconsin and Ohio and Indiana and all the rest. So they had to incorporate personal taxes and some simplification in it and get some kind of break to get it passed through. But it fundamentally was about lowering our corporate tax rates to motivate corporations and capital to build plants here in this country and stop putting them all throughout the rest of the world. So I think it has a very beneficial long-term impact to the economy. I think it's great for the American worker. It needed to be done. Japan, who had the highest corporate tax rate just a few years before, finally lowered it. I mean, even the most socially progressive countries like Sweden and the Scandinavian countries all lowered their corporate tax rates because they didn't want to lose the jobs out of their own economy. So I think the things that President Trump has done exceptionally well is the deregulation part that has helped free up the U.S. economy. I think the Tax Reform Act, there's aspects of it I don't like, which I'll get to, but I think what they did with corporate tax rates were absolutely right. There's some minor elements that, I would have liked to seen done a bit different. So I'm very positive on those aspects. Where is my big worry? And I'll get to California. My big worry is neither party is taking our deficit seriously. And this last budget bill by the Republicans was such a punch in my gut because I know Paul Ryan. I've talked with him about the implications of deficits, and the Republicans were fighting against the deficit spending of the Obama years, and here they go ahead and pass a big blowout budget themselves. And both parties are absolutely complicit with how much debt they have laddered into our economy over the last 20 to 30 years. And this we will have to deal with at some point, and my view is when this bill comes home to roost, it will make 2008, 2009, 2010 look like a happy time. When that unfolds, I don't know. Is it 3 years? Is it 5 years? Is it 10 years? Is it 15 years? It'll happen. It's just a function of when. So the good is deregulation. The good is a tax reform package to, help keep American companies here and capital here. And you're already seeing big capital flows coming back from companies like Apple back into this country. Heck, in Wisconsin, we have Foxconn, which is one of the biggest economic development stories in the United States history. They're going to build a plant with 13,000 employees. They can't find the employees, though. So there's a lot of good, but we still have this underlying issue of deficits that I'm very concerned of. Now, I'll shut up. I'll say one last thing, and then I'll turn it over. California versus the rest of the economy. The one big thing in the tax bill that impacts people in high-tax states like California, and California now the highest tax state, is you can no longer deduct your state income taxes on your federal tax. That is going to have a big impact on this state. Mixed in with all the crazy regulations, the labor laws that make it very hard to operate in this state as a business, I think is going to continue to drive wealth out of this state and certain business activity out of this state. The state gets away with it because the wonderful weather, because of Silicon Valley and all the rest, but when Silicon Valley cracks, and it'll crack, we had the big tech implosion, remember, back in 2001 and all the rest. And all that capital gain income that this state takes in evaporates. This state's going to be right back to running massive deficits, probably paying vendors with IOUs and all the rest. So I am concerned about this state and how it's progressing versus, and it's not just this state, it's Connecticut, it's New York, it's all these very high tax states. And this now, if you're a rational person and you have a high income, you're looking at it, and if you have the ability to move, geez, I could just move over to Nevada for 6 months and a day and save an awful lot of money.
So I'm going to go to Will next on this because we've seen a lot of our clients diversifying out of California, selling their assets here, 1031ing into Denver, Salt Lake, Boise, Texas, Las Vegas. What do you think of that strategy, and are you looking at any deals like that as well?
Yes, absolutely. Looking in a lot of those markets and have assets in those markets. Probably 150 basis point cap rate difference in those states, like compared to California. It's significant, especially if it's something you're going to do a long-term hold, put agency debt on, and keep. And if you're buying apartments or multi-tenant industrial, things that you don't have one big tenant that can hit you in a downturn, or long-term lease, single tenant or multi-tenant assets. We call them next cycle rent roll. If your rent roll goes out 7 to 10 years and gets you out quite a ways, or even north of 10 years, put long-term debt on it. Unless that tenant goes bankrupt, you're pretty fine with that asset. It's the deal that has a big tenant that's going to roll in year 3 or 4, and you listen to every panel everywhere. At some point, right, this recession's coming. It's coming, and rents are going to go down. And if interest rates are going up and rents are going down, and you got a big lease roll and a loan due, boy, you can figure that out now, because that will not be a happy day.
Well, on that positive note, we're running out of time. I wanted to make sure we had some time for Q&A. So I'd say, why don't we open up it to the audience for Q&A, and if we have extra time, I've got a few more questions. Right down there in the third row.
Well, I mean,
Did everybody hear that?
Tariffs.
So he asked about tariffs. How do you see tariffs affecting the economy?
So I think I'll just take a shot on that one. I think it's a big concern that we have, and it's really one that is a sort of like new facet of risk that we haven't necessarily had to deal with as directly as we do in this cycle. Basically, everybody we talk to, doesn't matter if it's a Democratic consultant, a Republican consultant, or consultants in China, they essentially all say the same thing to us, which is, this is likely to get worse before it gets better. And I think the model that that many just assume that we are going to see is what you saw a little bit with NAFTA 2.0. Where obviously there was a very hard line taken, with Mexico, and then there was a very hard line taken with Canada. But at the end of the day, we were able to get to a deal. Trade polls really well for Trump and the Republicans. It polled really well, and it did very well in this midterm election. So, again, the risk is that when you sort of play a repeated game in terms of trade negotiations, that you wind up in place and you look back and say, well, how did we get here, right? You wind up in sort of like a lose-lose quadrant, and so that's a risk, which is that you escalate, you dig in, and then at some point, again, you get to a point that is intractable. But our baseline is that while things probably get more challenging in the short term, they get more challenging before they get better, and potentially that lo and behold, that may come in sort of the most influential period, let's say before the next presidential election, but hard to know.
But it's a 4 to 5x delta, right? How long do those guys want to sit there and play that game?
Well, I mean, yeah. So it's a great question, right? And so part of the narrative is, well, like, aren't we winning the trade war, right? Like, look at our equity market and the performance of of our economy relative to the performance of theirs. But the Chinese don't think in 18-month cycles, generally speaking, right? They're not really worried about sort of the run-up to the next election. I mean, they build multiple 5-year plans, and again, the narrative is never fixed, so it's always changing. But the idea is this is an attack on their rise as a world power, not a cyclical attack on their stock market, their economy. So again, the risk is that they dig in other ways, for whatever it's worth.
Yeah, look, if we get in a trade war, it does hurt everybody. However, I do somewhat agree with President Trump. We already lost the war. I mean, we've been running massive trade deficits with China for a long period of time. And the more troubling aspect is the theft of intellectual property rights. I know personal stories where people went over open businesses and literally made a huge investment in factories and plants and all the rest. And within 6 months or a year and a half, another plant taking all their technology opened up right next door, owned by Chinese, and just eviscerated them, and they lost millions of dollars. And I literally know several real-life stories of that occurring. So, and there is no question China wants to supplant us as the world superpower. They state that. So, look, we will end up winning this trade war. We can break them faster than they can break us, because when you're already running large trade deficits, if everything starts collapsing on trade on both sides, they're taking vastly bigger losses, and they've got this huge population they have to keep employed. In saying that, as a government that controls everything, including the press, and if you're a dissenter, you will just disappear, they have the ability to weather pain far longer than we are in this country. I hope we reach a deal. I hope the Chinese come and make some meaningful structural changes, because it's not just us with China. It's pretty much everybody with China. The Europeans, well, they don't like some of the tensions that Trump's pushing back on them, on autos and all the rest. They're kind of giving the pat on the back of Trump, go after China. Everybody, every country, because they have had abusive practices for a long period of time. So net, yeah, it could get ugly for the next X period of time. I agree with Mike, it could get really locked down, but my guess is more than likely at some point a deal will be brokered somewhere in 2019, because it starts getting too painful on all sides, and cooler heads prevail.
Great. We have time for a couple more questions.
Any possibility of changing the state tax situation back to what it was, or changing it from what it is from 2011?
I don't think that has any chance of getting changed unless you had a new Democratic president, Senate, and House. There's no way a Republican Senate, and certainly not President Trump, is going to say, oh, we're going to put back state income tax deduction. One, that was a way they helped deal with lowering the tax rates without really blowing out the budget, number one. Number two, where are all the highest tax states? They're all Democratic controlled. New York, Connecticut, California. So why would they go about doing a favor? And, as a person who lives in Wisconsin, which isn't a low tax state, but certainly not where California is, it's always a little bit like, why are low tax states subsidizing, high tax states? It's kind of absurd if you really think of it. If you're in a zero tax state, why the heck are we subsidizing you because you don't run your states well? So I don't think that's going to happen. Now, post-2020, if you get a Democratic sweep that controls everything, yeah, you could get that change.
All right, one last question.
In light of Gavin Newsom's election yesterday, and some of the ridiculous pie-in-the-sky programs that he's proposed, coupled with the fact that California income tax is no longer deductible against federal income tax, do you have any ideas about what methods he's going to use to finance some of these programs? I'm particularly concerned about taxes on assets like intangibles tax on bank accounts that they used to have before they abolished that. Any thoughts on that?
You guys want to take this at all? I heard that he's talking about, who was talking about increasing the estate tax massively. Well, okay, that's a great idea. All you're going to do is everybody who's older that has built up a lot of wealth, you will guarantee they will relocate over to Nevada or Wyoming or Florida or someplace else. This isn't complicated stuff, folks. Taxes matter on a global basis, on a state level. They matter. And, Connecticut, which used to be one of the strongest economies in certainly in the Northeast for years because they had very low tax rates, it just became more and more progressive, increasing tax rates, and now people are flooding out of Connecticut. The state's in a complete fiscal mess, and they're hemorrhaging people. He's proposed a lot of kooky things, but how he's going to be able to justify and finance it, I really don't know. And his big threat into the state, a lot of Silicon Valley is starting to relocate a lot of their operations. We have operations in Salt Lake. It's called the Silicon Slopes, where they're just building out buildings up the I-15 and down the I-15 to, put a lot of their workers there. So, And we're seeing it in the Midwest. Silicon Valley companies, Zendesk just took down a big chunk of space in Madison, Wisconsin, moving employees out. So, this is going to start having some meaningful effects here fairly quickly for the state of California. And my guess is at some point the state's going to be in a world of hurt, and then some rational minds are going to have to come and make some adjustments.
Thank you. Well, I just want to say thank you to everybody for coming out today and for your thoughtful questions. And thank the panelists for coming up and sharing their knowledge with us. And give them a round of applause. So they'll be around for a few minutes if there's any follow-up questions. And thanks again for coming.